I don't know if you're a beginner trader, an experienced trader, or even if you're not actually a trader at all and just clicked on this video by accident. And if it is that last option, thanks for stopping by. I hope you find what you were meant to be looking for. Now, if you are an experienced trader, you may be able to know when it's the right time to make a decision about your trade, like whether to close it or scale in or scale out, simply based on how the market is moving at that particular point in time. You see, as you get more experienced, your gut feel and how in tune you are with the market movements can become pretty good. The problem is, most of you watching this probably aren't that experienced as traders, and some of you aren't as experienced as you might think you are. So when you make decisions based on particular movements in the price, it will quite often be as a result of loss aversion that you sort of disguise or convince yourself is you being in tune with the market. In other words, you're in a trade, the price fluctuates around a little bit, you get a bit nervous, butterflies in your stomach, and you close the trade, and then convince yourself that it was because you had some sort of connection with the market and knew what was going to happen. But you know the feeling, and I know the feeling, and I know you know the feeling of when you close a trade too early and then see it do what you expected it was going to do at the start, and then you kick yourself afterwards and think, I could have stayed in that trade longer like I was meant to. There was no need to exit then. So, if you're not an experienced trader, here's a quick tip for you that I would really recommend adding to your trading rules within your trading system. It's a simple one, but it is so effective. So here it is. When you make a decision to take any action in the market, you specify before taking the action exactly when you should make your next decision. Okay, so let's break down exactly what that means so it's clear enough that you can add it to your trading rules. Overall, this means that we will never be taking an action or making a decision in the markets without having a clear plan of what we need to do next. So first of all, what do we count as an action? Well, this can be any one of the following: opening a trade, staying in a trade following a specific decision about whether to stay in that trade or not, increasing your position size of an open trade, or decreasing your position size on an open trade. This doesn't need to be a rule for situations where you close a trade or choose not to open a trade, because then there's no further action to be taken. You're no longer in a trade, so you don't need to have a certain point in time when you're going to make the next decision. Next, specifying when you should make your next decision. This can be based on a particular price point or level in the markets. It could be based on time or just some other factor that may disrupt the trade, such as a news release. And here's what you're going to do. So let's say that you've opened a trade. You need to look at all of the potential outcomes and decide at what point, if the price moves in your favor or against you, that you'll be making your next decision. Now, usually if the price does move against you in a loss, then your decision in most cases will be already made for you with the stop loss that you've placed there. So the decision in that case is made. But if the price moves in profit, you need to know where you're going to be making your next decision. So let's say that you pick a level which may be the next realistic obstacle for the price. You may say that you'll make your next decision if the price reaches that level, but not any time before that. Or it might be a particular price point where you may be deciding whether to move your stop loss to break even or to leave it where it is, and you're not going to make any decisions before that. Or it may be a particular time. For example, you may want to make your decision at the end of that particular hour because that will be the end of your trading session, or that's when a dominant time frame will take over and potentially disrupt the trade that you're in. Or perhaps it might be that you're only going to make a decision just before a news release if you're trading based on fundamentals, or you think that a particular economic news release may disrupt what you're doing. The reason we set this rule is to make sure that all of our decisions in the markets are kept logical. Because when a trade's open, often our logical reasoning will just go out the window. It's just like what Mike Tyson said. He said that everyone has a plan until they get punched in the face. And when we have a trade open, our heads can be all over the place as well. It's like we've been hit by the markets. And sometimes in that case, all we want to do is to avoid taking a loss on our account and just bank any profit we can get, rather than making the right decisions for our long-term success and sticking to our plan. Okay, so what happens next in this process? Let's say that the price has reached our next decision point and we decide at that point in time we're going to take no action. We're going to leave the trade as it is, not touch it, it's still going to stay open. Well, for the sake of this rule, that still counts as taking an action because a decision has been made and you've chosen to not do anything with the trade. So when we make the decision, before we make the decision, we already need to know where we're going to be making our next decision, and so on and so on. So by following this process, we make sure that all of the fluctuations that have no bearing on our trade in between each of our important decision points are irrelevant to us. We know they're irrelevant and we ignore them because it's so easy to have a knee-jerk reaction to these random fluctuations that don't matter to your trade. So we wipe that out. And by doing so, our decision making can become a lot clearer. And if you set alerts or alarms based on your next decision points, you don't even need to babysit the trade most of the time. So if you find that when you're in a trade, then all of your attention and focus is being consumed by what's happening with that trade, soon after a while, you're going to find that you don't have that much to do in between your important decision points. The trade becomes a little bit more boring and you don't have to worry about it all the time. So I'm sure you can see how this is going to make your trading much more consistent, less stressful and anxious, and overall much better for your long-term success. I hope you found this video helpful, and if you did, then why not check out another video just over here? It's a good one. And if you want more videos about trade management rules and best practices, hit the like button so that we know that you want more of that, and then make sure you're subscribed to the channel so you don't miss it. Thanks so much for watching. I'll see you in the next one.